Two people start with nothing. One works 60 hours a week for 40 years and retires with a decent savings account. The other works 30 hours a week, owns a few businesses, and retires with $50 million. If you asked most people to explain this gap, they'd say the second person was smarter, took bigger risks, or got lucky. And maybe that's partly true, but there's a more fundamental answer. They understood what money actually does. Because money isn't just a tool for buying things. It's a system that, when you understand how it works, can multiply itself. And that shift from money as payment to money as a multiplying machine is what separates comfortable from genuinely wealthy. Let's start with why money exists at all. 10,000 years ago, there was no money. If you wanted something, you traded for it directly. You had grain, I had tools, we swapped. Simple enough. But barter only works when both people want exactly what the other has, at exactly the same time. Economists call this the double coincidence of wants, and it's a nightmare for anything beyond basic village trade. Imagine you're a skilled potter. You make beautiful, durable pots. But the farmer doesn't need pots this season. He needs his roof fixed. The roofer doesn't want pots either. He needs meat. The hunter doesn't need pots because he already has some. Your valuable skill is useless until you find someone who wants pots and has what you need. You can't save effectively. You can't plan. You can't specialize. The whole economy moves at the speed of coincidence. So humans invented commodity money, items everyone agreed had value. Shells, salt, cattle, cacao beans. These became the first currencies, not by government decree, but by collective agreement. This was revolutionary. Now the potter could sell pots for salt, save that salt, and trade it later for anything. Money became a store of value across time and a universal medium of exchange across space. But commodity money had problems. Cattle die, salt dissolves, shells break. Nothing was perfectly portable, divisible, or durable. Then came precious metals, and everything changed. Gold and silver were rare enough to be valuable, durable enough to last centuries, divisible enough to make any size purchase, and portable enough to carry. A gold coin represented something real, the labor to mine it, refine it, and mint it. When you held gold, you held crystallized human effort. For thousands of years, this worked beautifully. Money was essentially stored labor. If you had more gold, it meant you or your ancestors produced more, traded more, or conquered more. There was inequality, absolutely. Kings hoarded wealth while peasants starved. But the system had an internal logic. Wealth required corresponding production or plunder. You couldn't create gold from nothing. The money supply was anchored to physical reality. Then came the innovation that would eventually create billion-dollar fortunes. Banking. Medieval goldsmiths in Europe offered to store people's gold for safekeeping. In return, they issued receipts. These paper receipts started circulating as money, much easier than carrying heavy coins. But goldsmiths noticed something crucial. People rarely withdrew all their gold at once. Most of it just sat in the vault. So they started lending it out. If 100 people deposited one gold coin each, the goldsmith might lend out 50 of those coins to borrowers while still honoring all 100 receipts. As long as not everyone demanded their gold simultaneously, which almost never happened, this worked perfectly. But notice what just occurred. The goldsmith created 50 coins worth of money that didn't physically exist. They created it from trust and probability. This is fractional reserve banking, and it represents the moment money began producing money. The goldsmith earned interest on gold they didn't own. A borrower could take non-existent money, invest it in a trade voyage, and return with real profits. Money was no longer just stored labor. It became a tool for claiming future labor, for creating value that didn't yet exist. The implications were staggering. Previously, to get wealthy, you needed to produce something or take something. Now you could get wealthy by intermediating, by facilitating, by positioning yourself in the flow of money. The goldsmith didn't mine gold or make anything tangible, yet they accumulated wealth. This pattern would repeat and amplify for the next 1,000 years. Banks became more sophisticated. They didn't just store and lend. They created complex credit systems. Bills of exchange let merchants trade across continents without moving physical gold. Joint stock companies let investors pool resources for ventures no individual could fund. Insurance spread risk. Each innovation made the economy more dynamic and flexible. But each also made wealth accumulation less about labor and more about understanding financial mechanics. Then came the 20th century, and money underwent its most radical transformation. Countries moved from gold coins to paper currency backed by gold, then to paper partially backed by gold. Finally, in 1971, the United States severed the dollar's link to gold entirely. Money became fiat. It has value simply because governments declare it does, and people trust that declaration. This shift cannot be overstated. Money is no longer scarce in any physical sense. Central banks can create billions with keystrokes. The only constraints are inflation management, political will, and collective belief. We're operating in a monetary system that would be incomprehensible to someone from just a century ago. And yet most people still think about money the way their great-grandparents did. Here's where billion-dollar fortunes become possible, and where the wealth gap becomes systematic rather than accidental. In a fiat money system with fractional reserve banking, wealth flows to those who understand three things: assets, leverage, and time. Let's start with assets. When money was gold, holding currency meant holding something real and scarce. But fiat currency isn't scarce, it's actively being created constantly. If you hold cash, you're holding something that loses purchasing power through inflation. But if you hold assets, real estate, businesses, stocks, intellectual property, you own things that produce value or appreciate as currency supply expands. Two people have $100,000. Person A keeps it in cash, earning minimal interest. Person B buys a rental property, putting 20% down and borrowing the rest. After 10 years, person A has maybe $120,000. Person B owns an asset that generated rental income, appreciated in value, and was bought largely with borrowed money. Same starting capital, radically different outcomes, not because person B worked harder, but because they understood that assets appreciate while currency depreciates. Now add leverage, and the wealth gap explodes. Leverage means controlling more value than you actually possess by borrowing. Banks will lend against assets but not against labor. You can't go to a bank and say, I'm going to work really hard for 30 years, lend me $1 million. But if you own an asset worth $200,000, you can often borrow $800,000 against it, controlling a $1 million asset with just 20% down. When that asset appreciates 10%, you don't make $100,000 on $1 million asset. You make $100,000 on your $200,000 investment. That's a 50% return. This is how fortunes scale exponentially. Strategic borrowing isn't reckless. It's how most significant wealth is built. The rich don't avoid debt. They use it as a tool to amplify returns on assets that appreciate faster than the interest rate on the debt. Here's what most people miss. The monetary system is designed to reward this behavior. When central banks create new money, and they create trillions, it doesn't appear evenly in everyone's bank account. It enters through financial institutions and large borrowers first. These entities can access cheap credit and use it to buy assets before prices adjust to the increased money supply. This is the Cantillon effect, identified by economist Richard Cantillon in the 18th century. Those closest to money creation benefit most. By the time new money reaches wage earners, maybe a year or two later when employers finally give raises, asset prices have already inflated. If you're paid in wages and save in cash, you're being systematically impoverished. If you own assets bought with leverage, you're being systematically enriched. Same monetary expansion, opposite outcomes, depending on your position. Time is the final multiplier. Compound interest is powerful, but compound asset appreciation combined with leverage is transformative. A family that bought London real estate in 1900 didn't work harder than a family that rented. But their descendants now own assets worth 100 times the original purchase price. Appreciation compounded over a century. The renting family has nothing to show for a century of rent payments except canceled checks. This is how billion-dollar fortunes actually happen. Someone understands that money in a fiat system is abundant and depreciating. They focus on acquiring cash flowing or appreciating assets. They use leverage strategically to control more assets than they could buy outright. They hold those assets through time, letting appreciation and compounding do the heavy lifting. Eventually, they own systems, businesses, real estate portfolios, investment funds that generate wealth passively, independent of their labor. The person working 60 hours a week is operating in a fundamentally different system. They're trading time for money in an environment where money is constantly being created, diluting its value. They're saving currency that loses purchasing power. They're avoiding debt out of caution, not realizing that the wealthy use debt strategically as leverage. They're playing by rules that worked when money was gold, but money hasn't been gold for 50 years. None of this is moral commentary. The system isn't fair or unfair. It's just mechanics. Money evolved from a simple trade facilitator into a complex wealth multiplication engine. Each evolution, from barter to gold to banking to fiat to digital, made the economy more sophisticated and dynamic. But it also made wealth accumulation increasingly about understanding financial mechanics rather than working hard. The most successful people aren't necessarily the smartest or most deserving. They're the ones who figured out that modern money is a game with specific rules, and those rules reward ownership, leverage, patience, and positioning within the system. Everyone else is still thinking money equals payment for work, a framework from an economy that no longer exists. Billion-dollar fortunes don't come from billion hours of work. They come from understanding what money actually does in a system designed to multiply it for those who know how to position themselves. The gap between those who understand this and those who don't isn't about intelligence or effort. It's about operating in entirely different financial realities, using the same currency. If you want more clear breakdowns of how financial systems actually work, no hype, no agenda, just mechanics, subscribe. The next video explains exactly why debt makes some people rich and others poor, and the crucial difference most people miss.